Did you know that nearly 80% of a stock's weekly price movement happens on just 2 days, Monday and Friday? The rest of the week is often just noise. That's a staggering statistic, and it means if you're not paying attention at the open, you're already behind. You're probably staring at your screen every Monday morning, watching the market gyrating, feeling that familiar mix of excitement and anxiety. Is this a dip to buy? A fake rally to sell? Or just random chaos? The truth is, the market isn't chaotic. It's communicating. And it gives away its biggest secrets in the first hour of trading on Monday. I'm going to show you how to listen. In the next 10 minutes, you'll learn a framework to cut through the noise and spot the real, actionable trend for the entire week ahead. This isn't about day trading, it's about strategic positioning. It's about gaining a massive informational edge that tells you whether to be aggressive, defensive, or patient. Let's start with the single most important chart you need to look at before you even think about any individual stock. It's the US dollar index index, or DX. The dollar is the world's reserve currency, and its strength or weakness sets the tone for almost everything. A sharply higher dollar on Monday morning tells you one story. It tells you there's a flight to safety. Investors are nervous. They're pulling money out of risky assets and parking it in the safety of the dollar. This is typically bad news for stocks, especially for tech and growth names, and it's often brutal for emerging markets. Conversely, a weak dollar on a Monday suggests risk is on. Money is flowing out of the safe harbor and into riskier, higher return investments. You need to note the magnitude of the move. A 0.3% move isn't a tell. But a 0.8% or 1% surge or collapse? That's the market shouting its intentions. Next, you need to check the bond market. Specifically, you need to look at the yield on the 10-year US Treasury note. Think of this as the market's heartbeat. Now, the key is to look at the direction of yields and the movement of the stock market together. Are they moving in the same direction, or are they diverging? If stocks are up and bond yields are up, that's a risk-on confirmation. It means investors are optimistic about growth. They're selling bonds, which pushes yields up, and buying stocks. This is a healthy, bullish signal. But if stocks are up and bond yields are sharply down, that's a major red flag. This is a divergence. It suggests the stock rally is fragile, perhaps driven by short covering or technical factors, while the smart money in the bond market is betting on a slowdown or trouble ahead. This is one of the most reliable Monday morning warnings you can get. The third tell is market breadth. This is where you look under the hood of the major indices like the S&P 500. Is the rally broad-based, or is it being propped up by just a handful of mega-cap stocks? You can check this by looking at the advanced decline ratio. If the S&P is up 0.5%, but you have 400 stocks declining and only 100 advancing, that is a massively bearish signal. It means a few giants like Apple or Nvidia are masking widespread weakness beneath the surface. It's a hollow rally. Conversely, if the index is flat or even down slightly, but the advanced decline ratio is positive, with more stocks up than down, that's a sign of underlying strength. It tells you that the selling pressure is limited, and there's a solid base for a potential move higher later in the week. Breadth doesn't lie. The fourth tell is sector rotation. On Monday morning, you need to see which sectors are leading the charge and which are being dumped. Are the defensive sectors like utilities, consumer staples, and healthcare leading the market higher? That's a defensive, cautious rotation. It tells you investors are battening down the hatches, expecting volatility or a downturn. Or are the cyclical sectors like technology, industrials, and consumer discretionary leading? That's a pro-growth risk-on signal. It shows confidence in the economy. Let me give you a specific example. Imagine it's a Monday morning and the market is worried about an upcoming inflation report. If you see money flooding into energy and financial stocks, that might signal the market is betting on hotter inflation. But if you see a rush into tech and growth stocks, it might be betting on a tame number. This sector story gives you the why behind the price action. Our fifth tell is volatility, specifically the VIX index, often called the market's fear gauge. But most people misinterpret it. They just see if it's up or down. The real secret is to watch its behavior. On a Monday, after a calm weekend, if the VIX is spiking higher while the market is only down slightly, pay attention. This is called a volatility divergence. It means the options market is pricing in much more turbulence than the current stock price action reflects. It's a warning that professional traders are buying protection, expecting bigger moves. It's like seeing people suddenly buying umbrellas on a sunny morning. They've seen a forecast you haven't. Conversely, if the market sells off but the VIX remains stable or even falls, that suggests the sell-off is orderly and not driven by panic. It might just be a healthy pullback. The sixth tell is the action in the Mag 7 or other major market leaders. These stocks carry an enormous weight in the indices. On a Monday, you need to see if they are confirming the broader market's move. If the S&P torpille is green, but 6 of the 7 megacaps are in the red, that is a huge warning sign. The rally is narrow and vulnerable. But if the market is down, yet you see names like Microsoft or Amazon holding key support levels and not breaking down, that's a sign of resilience. It tells you that the core of the market is still strong, and the dip might be a buying opportunity. These leaders set the tone. If they crack, the whole market often follows. Finally, you have to look at the global session. The US market doesn't trade in a vacuum. What happened in Asia and Europe before our open? Did the Chinese markets sell off on property fears? Did European banks get hit? Often, a trend that starts in the Asian session will ripple through Europe and then land on our shores at the open. A coordinated global sell-off is a much stronger signal than an isolated US move. If Asia was weak, Europe was weak, and then the US futures are deep red, that's a clear, unified trend. Conversely, if the US is trying to rally while the rest of the world is in a slump, be skeptical. The trend lacks global confirmation. So, there you have it. Your 10-minute Monday morning checklist. First, the US dollar for the risk appetite. Second, the 10-year yield for confirmation or divergence. Third, market breadth to see the true health of the advance or decline. Fourth, sector rotation to understand the narrative. Fifth, the VIX behavior to gauge fear levels. Sixth, the megacap stocks for leadership confirmation. And seventh, the global session for context. You don't need to be a professional trader with 6 monitors to do this. You just need a disciplined 10-minute routine. Look at these 7 tells, and you will no longer be a passive observer of the market's chaos. You will be a reader of its intentions. You'll know whether the week ahead is likely to be a risk-on party, a defensive grind, or a volatile roller coaster. This knowledge allows you to make smarter, more confident decisions with your portfolio every single week. If you found this framework valuable and want to take your financial literacy to the next level, then you need to subscribe to this channel. We break down complex market concepts into actionable strategies every single week, giving you the tools you need to become a more informed and successful investor. Don't just watch the market, understand it. Hit that subscribe button and turn on notifications so you never miss an insight.